thank you for joining us on this webinar looking at how investors should navigate the recent market volatility we've seen in Japan and across Asia. My name is Kerry Craig. I'm part of our Market Insights team here at JP Morgan, and I'm very pleased today to be joined by two featured speakers, Isa Ogashi from our Asia Pacific Equities team, portfolio manager there, and also Nicholas Weindling, a portfolio manager across the Japanese equities space. They're going to be diving more into what we see in terms of how Japan equity markets are faring in the current volatile environment and our expectations going forward, as well as how they're seeing positioning across their funds. We'll be doing the same with ISA, taking a slightly broader view, looking at the Asia Pacific region, given we've seen some volatility moving across the region more broadly, and given that risk-off sentiment that's permeating around the world. Before I turn to Isa and Nicholas, I just wanted to take a minute to provide a bit of context around how we're viewing things, particularly within the US, given that has been a center focus around the outlook for rates from the Federal Reserve, and whether we should be placing a huge amount of weight on the very limited data we have so far around the direction of the US economy. Now, our characterization of the US is very much a market that is cooling in terms of the economy, but it is not contracting. Now, while we do see the probabilities of a recession having risen, given that slowdown in growth and the fact that as your economy goes slower, it takes less of a shock to actually tip you into recession, our base case still remains for an economy that can continue to move along at potentially a slightly sub-trend pace of growth. Now, we can just look at the economic data that's come out and see that softening that's happened across either some of the manufacturing surveys or the labour market. But I would still stress that we are seeing momentum in the economy if we look at the consumption that's out in the GDP figures we've had over the first half of this year, or even if we look at the factors which have typically been excessive when we have seen large recessions in the past outside some of those shocks such as the pandemic. You look at investment as a share of GDP across the residential space, business investment as a share of GDP, or even inventories to sale ratios. These are all things that generally get highly distorted before a recession occurs, indicating there's some imbalance in the economy. And that's not where we are for the US economy today. It does very much feel like either a mid to late cycle based on a lot of the indicators we are seeing. When it comes to the labour market, again, the non-farm payrolls we had last week did surprise the downside. There was a disappointment there. Some of the underlying information was also relatively weak. But we are still seeing jobs added to the US economy. It was 100,000 jobs being added. We do know that number can get revised as it does in the past. And so we again be thinking about what the potential for that to change is. And we're also very conscious of the fact that that participation rate went up. And it's more of a case of new entrants to the labour market finding it slightly harder to get a job than those currently in the labour market, which does feel a little bit more balanced in our view. Now, when it comes to the Federal Reserve, obviously they're now more focused on thinking about the balance of risks across inflation and the labour market, given their dual mandate. On inflation, it is coming down. We do see it forecast to come back down to their target within the next year or so. Take personal consumption expenditure, PCE, which is their preferred measure of inflation. It's sitting at 2.5%, very much is in striking distance of getting back to their target. And so we think it's appropriate that they're now thinking about easing policy on that basis. Now, our assumption had been that we would see 150 basis points of easing from the Federal Reserve over the course of 2024 and an outlook into 2025. And that's a relatively moderate easing cycle in historical terms. What we may now see is that path back to a neutral rate and that 150 basis points of easing just comes through in slightly quicker concessions. So we may see a 50 basis point cut in September, but I think a lot of that still depends on the incoming data, and we should be a little bit conscious about how much easing the market is pricing in relative to those expectations, when we could see some stability in the data, and I think the Fed will be looking at the same. There's also an issue here with messaging. Aggressive cut by the Fed could be seen as signs of further weakness in the economy, perhaps a bit of what do you know that I don't. And so it is a case of thinking about the Fed messaging of getting back to neutral on rates, given those balance of risks around the inflation outlook and labour market, without causing some of those scares in the economy. And again, that's where we may see somewhat of an accelerated easing cycle, but not necessarily thinking about a vastly more deeper cycle than we had been contemplating just a couple of weeks ago. So with that as a backdrop, not a recession as our base case, but some signs of potentially weaker growth in outlook and probability of recession creeping a little bit higher. I think it's important to have that context when we start to think about the very dramatic moves we've seen in just a few days across the equity markets around Asia, and particularly in Japan, which has been pretty much the epicenter for some of these very dramatic moves. So I very much want to start with some questions for Nicholas on Japan and what we're seeing. The first question, I'm sorry, Nicholas, is probably one of the hardest around what's really behind this move in terms of what we've seen in Japan equities and why it's feeling the pressure more than other markets. There's a lot of focus on the carry trade, which, as we've discussed, is something that is very hard to quantify in absolute terms. But I was wondering if you could run us through your views on, what's been behind the pressure in Japan, how much of it is this carry trade versus other factors which may be creating this weakness, and really where you're seeing the market from here.
Hey, thanks so much, Kerry-Ann. Hello, everybody. I think we should first start off by saying that this really was an enormous move that we saw in Japan. Just to give you some context, over a 3-day period, that was the biggest ever 3-day fall in the market. So that means bigger than anything we saw during COVID, the global financial crisis, or even the earthquake that we had here in 2011, when I remember sitting in the office and people being worried about what was going to happen to the nuclear reactor in Fukushima. So, it's a very, very big move. To kind of cut to the conclusion, we think that the major reason for this is to do with something that's going on in financial markets, and that it is, although there has been some change in the data, which Kerry alluded to, nothing at all on the scale to justify the scale of the move that we've seen. So we do think that the number one explanation is some unwinding of the carry trade, and that there was people who were using leverage in those trades, and they're forced to unwind that. And so everything sort of feeds on itself. And so that is the number one explanation for what's going on. And we think probably accounts for the overwhelming majority of what we've seen. But it's not the only thing that has gone on. And certainly if there hadn't been other things that were happening, we wouldn't, that was the trigger for why we saw this big move. So we just briefly talk about what the sequence of events. The first thing that happened was that the Bank of Japan hiked policy. Now, hiking rates was not unexpected. But in the press conference given by the governor, Ueda-san, he opened the door to successive rate hikes. And that was unexpected and much more hawkish than the market expected. And that's what led to the yen starting to strengthen. We then saw a couple of days later the weakened expected employment report in the US. So what you have there is, on the one hand, you've got Japan starting to tighten policy, but on the other, there's an increased expectation of the US loosening policy. And that is quite a big shift. One of the big features of the Japanese market over the last few years actually has been the very weak yen. In fact, I'd say that for all the great things that are going on in Japan, and when we talk to clients about what's going on here, and we see a very high level of interest, much more so than we've seen, but one key concern of them has been the weak yen, because, okay, the market might have been doing well, but for a dollar-denominated or euro-denominated, whatever else denominated investor, some of that was being eaten up by the currency. So in this respect, the yen starting to strengthen is not a bad thing. The reason why the yen has been so weak is because we had this very big interest rate differential, and that may, I would definitely underline may, start to close. Because if we go back to the beginning of this year, people were also saying that we're going to see US rate cuts, that slightly looser policy is going to mean that we're going to see yen weakness. But actually, even as we sit here today, we're at a weaker level on the yen than we were back at the start of the year. So it's really this sequence. It's the BOJ, particularly the BOJ press conference being more hawkish than expected, followed up by this weak US jobs report. And those two things are the catalyst for what we see as this big move. But let me say again, yes, those things are important, but nothing that would justify anything like the scale of the move that we saw in Japan.
That's a brilliant lead-in for the follow-up question I had there, because obviously you've had, I believe, the deputy governor from the Bank of Japan come out slightly less hawkish, or really walking back some of those hawkish expectations, saying, maybe we're not going to hike rates again this year. Again, if they want a weaker yen, that messaging would suggest you're going to see the yen, if they want a stronger yen, that dovish message would suggest the yen's going to go in the other direction. What are your expectations now for the Bank of Japan, given that you've had a couple of days and a couple of the different speakers come out?
Well, firstly, I should say that we are stock pickers, and that's what we spend all day, every day doing, and meeting companies. Being based here in Tokyo is a great advantage for that. But still, we obviously have opinions about what's going on at the Bank of Japan and so on. I think one big central question with the Bank of Japan is that actually economic data in Japan is not that strong. Consumption has been quite depressed. So even though we've seen record wage hikes here, I mean, they're the biggest wage hikes for 30 years, around 5% in the wage agreement this year. Now, compared to other countries, that's not a particularly high number these days. But for Japan, it really is, because the average person in Japan hasn't seen their wage go up for really ever during their working career. So for the BOJ and the authorities here, one big question is, why is consumption failing to pick up? And the key cause is the weak yen. So as investors, and certainly when I go and meet investors all over the world, there's an idea that weak yen is good for Japan and good for Japanese profits. And that is definitely true. But as far as the market is concerned, yes, companies make more money in aggregate when the yen is weaker. But for the average Japanese person, the weak yen or 2-week yen causes significant issues. That's because Japan has no natural resources. Everything is basically imported, and Japan's very dependent on imported food as well. So when the yen weakens, these prices are going up, and it is pressuring consumers. And so for many people, this is I guess in the West, people would say there's something of a cost of living crisis going on. So for many people on this call, it's great coming to Japan at the moment because it's so cheap here. Prices are way beneath. Considering this is such a mature economy and developed, and Japan always had an image of being a very expensive destination. But as I'm sure many of you know, actually, that's just not true at all anymore. Prices here look very low compared to the rest of the world. But for people who live in Japan, they really feel the effects of this weak yen. So the BOJ wants to address that issue, and that could in turn help the economy to become that much stronger, and you'd start to see a kind of consumption recovery. So in terms of the BOJ trying to walk back those comments, that is it's interesting they do that, but I expect that what is much more important now is what happens in the US. And this has been true for a while, because when it comes to the level of the yen, it's partly to do with Japan policy, but it's also much more to do maybe with what's going on in the US and US policy, or ECB, or the Bank of England, and so on. And if conditions there are slightly weakening, maybe we're going to see rate cuts, then that alone could be enough to see the yen stop weakening and even start to reverse trend.
Again, something else I wanted to ask you about, and often the view within investors looking into Japan is obviously weak currency, great for exporters, that's how you play the market. You very rightly pointed out there's been some weakness in domestic consumption. You just look at the GDP reports for the last couple of quarters in Japan, you've seen that being very evident. We have seen wage growth go up in Japan, so we're thinking about that being a positive, but those inflationary pressures still being a headwind. When it comes to your positioning within your portfolios, how are you thinking about the external demand and the benefit from a weaker currency for the exporters versus positioning for maybe improving domestic demand? How do you balance those two different things within a portfolio, or are you focusing more on one and less on the other?
Well, firstly, you should say that some inflation in Japan is a very positive thing. We have been mired in deflation here for decades. And it is perfectly normal for prices to go up over time. It just hasn't been the case here. Deflation is very difficult because there's never an incentive to buy something today. It's going to be cheaper in a month or a year or something. So this is very, very tough. And it is very good that Japan at the moment looks like it's got out of that deflationary cycle. It's also very good that we've got wage rises going on in Japan. So yes, the companies are doing very well, but up until recently, they've not been passing that on to workers. And now we start to see it. So these are absolutely good things. And when it comes to looking at stocks within the market, we need to be quite careful about when companies report good earnings and they are really only because the yen is weak. That is not really, those are not high quality earnings. Or those companies which aren't that competitive, but have been given a massive competitive advantage globally because suddenly they got this weak yen, and so they can really push on their pricing very hard. In contrast, what we want to do is focus on high quality businesses who really, doesn't matter whether the yen is strong or weak, or particularly the global economy is doing well or not well, that they're able to generate good earnings or be relatively more resilient. And so we've been quite careful in those very FX sensitive stocks. Actually, just if you look at the dynamics of the market in Japan over the last, let's say, 3 years, it's been quite an unusual market here, and it has been very value dominated. That's in stark contrast to what's going on in the US, where you've obviously got the Magnificent Seven. It's been a very growth market. And the key reason why Japan has been a value market is because the weak yen is very positive for areas like car companies or maybe steel companies or companies that make diggers, these kind of companies, which suddenly have been handed a big competitive advantage, even though they're making quite a commodity product. And another group of companies which have done well are interest rate sensitive stocks, because there's an expectation that rates are going to go up in Japan. Now, these are all value types of companies. If the environment is now changing, maybe the yen isn't going to keep weakening to that extent. Maybe the BOJ can't keep hiking rates anymore because they've just seen what happens when they do one. And maybe the work will be done for the BOJ anyway by the fact that their Fed cuts. That could mean leadership within the Japanese market, which has really stood out, as I say, as being a very value market. That could change from here on.
And then again, the point around the earnings growth, you focused on quality companies. I mean, I was just looking at the numbers this morning, the earnings outlook, the consensus data from FactSet, we're looking at 2024 earnings growth of about 12%, 2025 slightly lower at 8%. I mean, what are your expectations for earnings for Japanese equities relative to consensus? And also, if you could, sorry, a very long-winded question, again, think about, is that representing value, given that we have seen the valuations come down a little bit in the Japanese market? It's certainly not screening expensive when we look at where it sits relative to its history.
Yeah, I mean, firstly, the numbers you give there, Kerry, I think we broadly agree with them that that's what we're expecting, so long as things continue as they are. So what I mean is that if you look at sell-side consensus on the yen, we're looking at probably a range of maybe 145 to 148. It's broadly where we are now. If the yen starts to strengthen, then it will weigh on earnings growth in Japan. We still expect to see earnings growth all the way. I mean, even if the yen was to strengthen as far as even 130 or a bit beyond that, that would still be okay for earnings growth. But still, it would mean that earnings growth would be cut. And Japan is also a very, has more cyclical companies within the market than elsewhere. So if there are concerns about global growth, then that could also start to weigh on earnings expectations overall. But you make a very good point about valuations. And because of the size of this move in Japan, you're now looking at a market which is trading right at the bottom of its 10-year range. I don't know, that's, as of today, probably around 12.5 times or something PE. So it's a significantly lower than where it's been over the last 10 years. And it's also significantly lower than many major markets. And I think many of those positives that had driven the market over the last few years, and particularly in the last year, none of these have changed. In fact, if anything, the improvement in corporate governance, which has been dramatic, and I think whether it's me or Isa or any of the other over 20 people on our team, and we've been doing Japanese equities on average for over 20 years. The changes and improvements have gone way beyond what we'd expect. In fact, things like share buybacks in Japan this year really look quite exponential versus what we've seen over the previous years. So there's no change in any of this. Yet suddenly the market is trading on this much significantly lower multiple than even it was a week ago. And I think that is something that we're very, very focused on. Even in this kind of turbulent period over the last week or so, we've still seen big share buyback announcements. We've seen companies doing MBOs. We continue to see cross-sharehold unwind. These are all very good things, and we do not expect to see any shift in this dynamic.
I was going to say it might be actually an opportunity for companies to increase share buybacks given the prices have come down a little bit, but I wouldn't want to overstep my understanding of the market on that one. A few more questions have come in, Nicholas, on Japan, which we'll come to at the end. But I wanted to turn to Isa to think about, firstly, Japan in the broader context of what you're doing, Isa, and allocating across the broader Asia-Pacific region. I mean, are your views of Japan very similar to what we're hearing from Nicholas so far, or slightly different? And then how are you viewing Japan within your portfolios looking across the region?
Yes, thanks, Kerry. So we have very similar aligned views on Japan, so very positive. The development of the corporate governance improvement, all of that has been positive. We have been overweight Japan in our portfolios. I have to say the weak yen has been a headwind. So the most recent developments have been a positive for us. We continue to remain overweight. There are a lot of good things happening. As Nicholas mentioned, we expect domestic economy to show, better, I guess, recovery going forwards with the weak yen abating. So yes, we're very much aligned, and we remain positive on Japan within our portfolios.
And then more broadly, obviously, we've seen big moves across some other markets around Asia, not to the extent of what we've seen in Japan, but still some pretty hefty moves, and still some settling going on at the moment. Taiwan, Korea, very notable in terms of the movements we've seen there. Those are two markets that we think about very much in terms of being in tune with the global supply chain, very much being in tune with what we're seeing across the AI secular theme, given semiconductor production. I mean, how much are they just getting caught up in the crossfire here in terms of that broader risk-off sentiment, or is it something else that's, again, weighing on those markets relative to what we're seeing in Japan?
Well, I would say, Korea, Taiwan are two very tech-exposed markets, as you mentioned. For Korea, tech is about 40% of the market, and Taiwan even higher at 60%. So it's not a surprise that we saw the correction over the past week. But, what can we expect going forward? I'll start with Korea. We are still constructive on the semiconductor memory industry, but there are other good things happening. Just like Japan, Korea is embarking on a value up program. So this is a regulator-led corporate governance improvement. And even as most recently, we saw one of the major banks come out with their first ever value up program. So this consists of ROE targets, shareholder return targets, their stock cancellation targets, all by 2027. And I said this was their first ever, but it's probably not an exaggeration to say it's probably the first ever for the entire of Korea for a major company to come out with these targets with concise timelines. So this is very positive, and we believe other corporates will follow. And another area that's really interesting in Korea are the heavy industries. So this is a sector that has seen very little capacity increase over the past 10 years, has very high entry barriers, where they're seeing now very strong demand recovery. So whether it be smart grid capex globally or shipbuilding. These are areas where Korean companies have very strong competitiveness. They're leaders in these sectors, and we believe we will see profitable growth over the next couple of years. So non-tech is also very interesting in Korea. Now for Taiwan, like I said, 60% of their market is tech exposed. And here we continue to look for tech opportunities, but shifting more to the, from the NVIDIA AI supply chain, maybe slightly more towards the edge device supply chain. So edge device, meaning these are PCs, laptops, smartphones with AI capabilities on the device. I admit it's very early days whether these products will be popular and accepted in the general public. But if and when it does, Taiwan supply chain, again, will be the winners in this area.
And then just on Korea and Taiwan, the performance of those two markets has actually been quite varied this year. And this is something that comes up with clients a lot. I mean, very constructive case for Korea I've outlined there, but the performance of the market hasn't really reflected that in aggregate. I know you're obviously looking bottom up at the companies, and then Taiwan is doing very well. I mean, is there a reason why you're seeing that big dispersion in index level performance?
Well, I think it comes back to the whole issue of corporate governance. Taiwan traditionally has been a market, or the corporate mindset is very much pro shareholder returns, very high dividend payouts, very high ROEs. And so that coupled with strong earnings growth, it's not a surprise that that market has done very well. Korea, as I just mentioned, they have just embarked on this improvement in corporate governance and improvement in shareholder returns. So I think that's probably one of the main reasons that has been a big divergence.
And then we actually have one of our US equity portfolio managers here in Australia at the moment, doing some events with them, talking obviously about the volatility in the market. And they use this phrase, he said, well, this is an opportunity to sell the things you like, but to buy the things you love. So effectively taking the sell-off as an opportunity to maybe double down on some of those stocks that you really favor, you have high conviction in. I mean, is that something you're doing at the moment, given what we've seen in the markets? Is this an opportunity to get more of those stocks which you do think have that strength in the earnings outlook and will deliver on those?
Yes, given the sell-off has coincided with earnings season, so it has provided us with opportunities to maybe take some money off the more trading type names or themes that we have been invested in, and take a relook at some of the names, as you say, that we love, that are very high quality, high growers, and shift into those names given the valuation correction.
And then those themes, obviously we talked about Korea and Taiwan, you mentioned shipbuilding, you're thinking about moving into those edge kind of devices and the things that will take advantage of the AI. More broadly across the Asian region, are there other themes that you're building into your portfolio that you see as more persistent in terms of delivering on that growth and that return?
Yes, so this is related to the whole interest rate environment. But up till now, we have seen North Asia, well, specifically Korea and Taiwan, lead the Asian region performance. And markets like ASEAN has lagged, and this is partly because high interest rates, weak currencies that have been a drag on their actual economies. Now with the interest rate change, I guess regime changing a little bit, we might see more demand or more interest in these markets. And also, as people may know, China has been a big laggard this year with weak macro and persistent weak consumption. But valuations are at very, very low levels. We have seen some positive policy tailwinds over the past couple of months, and not to the extent of Japan and Korea, but China is also looking into better corporate governance and better corporate practices from the regulator's point of view. So these are providing some attractive opportunities for us as well.
You mentioned those more rate-sensitive sectors, potentially being an opportunity. If we do think about the Federal Reserve cutting, obviously by a larger amount, or the magnitude being bigger sooner, if they do that with avoiding recession, we should think about obviously a weaker US dollar, lower rates. Historically, those have been quite good for emerging market assets and emerging market Asian assets. I mean, does that create room for central banks across Asia to start cutting rates to support the domestic outlook, or is that too soon to tell given some of the domestic focuses on inflation that can vary by market?
I think it definitely creates room for more monetary easing. So post-COVID, we have seen very uneven recovery within each economy. So, for example, again, I'll take Indonesia as an example, where the corporate sector has been doing very well. But on the other hand, consumption or consumer have been very weak. This is because of higher rates. So the monetary easing will have a positive effect on that to even out the economic recovery. And that would be the case for the other parts of the ASEAN economies as well.
And sticking with, somewhat of the influence of the US, we're thinking about allocating across Asia. The US election coming up, we're getting a lot of questions around what's happening there and potential. Obviously, trade is pretty high on the political agenda. We've heard talk around potential for wider tariffs across all inputs into the US. I mean, how are you thinking about those reshuffling of supply chains, which have benefited a number of Asian markets, the consequences of potentially what could be more tariffs across the region? Is this even a feature of how you think about allocating in the markets, or does it influence your decision-making in terms of the companies that you're looking at?
I would say those risks are, of course, they're in our minds, and we try to have a base case scenario and then move on. So for U.S. elections, geopolitical risks, I would say we would have it as a constant, i.e., no change from what we are seeing now. We're not expecting anything to get better or anything to get worse. And we need to reassess those assumptions if, as and when these issues surface again. But I think one thing to note is that although these, trade tensions have been a negative for China, on the other hand, it has been a very big positive for economies like Korea, or even for some of the ASEAN countries like Indonesia. So as a regional portfolio, I think we're able to navigate these risks quite in a better way.
Yeah, absolutely. I think definitely our view around the election is still, it's a very close thing to call at the moment. There's no guarantee around what the outcome would look like. So we're very cautious about, again, placing too much weight in how we think about investing simply around that one outlook. And again, when it comes to that reshuffling of supply chains, it's been something that's happening for a number of years now. And it's not just the case of thinking about goods being passed through from one country to the next into the US, but also thinking about the development of perhaps new manufacturing hubs across the Asian region, which would be something that's more persistent in terms of a growth story. Fantastic. Nicholas, Isa, thank you very much for your time today to walk us through how you're seeing the Japanese market as well as things around the rest of the region. Always valuable to have your insights for our clients. If you want to know the views of Market Insights on a very timely basis, we do put out a podcast nearly every week, if not more frequently, depending what's happening on the market. You can scan the QR codes on your screen. That'll take you to the relevant streaming service for you and your location to be able to listen to that. What I'm hearing from both Nicholas and Isa is around the fundamentals of where you're investing in these regions really haven't changed. That focus on quality, that focus on earnings deliverability, and again, valuations that don't seem like they're stretched in any of the markets that we've mentioned today, all provide that backdrop for thinking about those longer term returns. There is going to be volatility and choppiness till we do get clarity around the direction of the economy, perhaps some first tier data that really signals that we're not heading for that recession, or some more firm comments from central bankers both across the US and Japan about the direction of policy. So things may remain volatile, but we're here to build wealth over the medium term. We're thinking long term. I think there has been a good opportunity created given some of the concerns around how much the market had run in the first half of this year. Again, any other questions, do please feel free to reach out to your JP Morgan representative. Very much appreciate your time today. Nicholas, Isa, thank you again for your time, and we will talk to you next time.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.